The world is on a precipice of a major shift. The monetary reset has begun, and we need to get ready. This program aims to inform you on how the monetary system works, how it has been used to rob you of your wealth. I will take you on a journey of discovering what has happened until now, what events are shaping how we will live our lives, and how you can prepare yourself for the biggest wealth transfer in history. Fractional reserve lending is the currency that can be created without minting new coins or printing new banknotes. This is when the banks take our deposits and lend them out for interest. They in turn pay you a percentage of those returns in interest on your deposits. The rules are quite specific as how this works. The banks have to hold a percentage of the deposits and are allowed to loan out the rest. In some countries, the percentage varies from 0 to 10%. What this means is that a deposit of 100 Rand, the bank then holds 10% or 10 Rand and loans out the other 90% or 90 Rand at prime plus a percentage. The 90 Rand comes back in payment of the loan, and then they keep the 9 Rand or 10% and loan out 81 Rand, and so this goes on and on. Essentially, the banks have created digital money out of thin air, where the money loaned can be 10 times the initial deposit. A credit card works even better than this for the banks, in that they don't need any deposits, but create this facility out of thin air, which, because they have no reserves against this, the risk is higher, therefore they charge much higher interest. So looking back at part 3, where consumer debt stands at 1.6 trillion Rand, it is highly probable that all that debt was created out of thin air for us to buy our car, our home, clothes, food, TV, etc. We then have to pay it back with real currency, with interest. Now, if we had to create currency out of thin air, it would be called counterfeiting, and we would go to jail. So the financial rules and the laws for the banks and the people are different. In South Africa, the fractional reserve rate, according to the South African Reserve Bank website, is 2.5%, meaning that for every 100 Rand you deposit, they only need to hold 2 Rand 50 and can loan out 97 Rand 50. So if every depositor in the country had to go to the bank at the same time to withdraw all their funds, the banks would shut down. And mathematically speaking, you could only get 2.5% of the money you deposited. An example of this was in Greece a few years ago, where the bank stopped depositors from withdrawing more than 50 euros a day, and many lost millions with their banking collapse. Many banks around the world only insure up to $10,000, and many more even less, or even a percentage of your deposit, which means in case of a banking collapse, that would be the maximum they would cover you for. If you had more, or much more, then you would lose it all, as it happened in Portugal and Greece a few years ago. However you look at it, the banks provide a service of giving depositors interest, but push all the risk onto the depositors and all the rewards onto the banks. I'm giving you a high-level view of how things work. For more detailed info, you can research deeper. In summary, local banks outside the central banking, under certain laws, can produce currency out of thin air, charge interest, make huge profits, and transfer all the risk to the depositors. If you have 1 million Rand in your bank account, I choose 1 million just for an example, and banks can create 10 million Rand towards mortgages, charge the borrowers 10% per annum over 20 years, making 10 million Rand profit, and pay you 7% on your initial 1 million Rand deposit of 70,000 Rand before taxes, netting themselves 9.93 million Rand before tax, and your initial deposit isn't even secured. This is the format by which banks operate, taking your profits and buying big buildings, properties, shopping centers, etc., which is the real wealth, not the currency or paper that you are given. Subscribe to my channel, like, and share this video. Thank you.